Anthony Grasso here, bringing you financial news that you can use. In this video, we're going to do a stock analysis on HubSpot. Is this software giant worth investing in right now? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and then give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So of course, this video is brought to you by Webull, where it's an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so what is HubSpot? It provides a cloud-based customer relationship management CRM platform for businesses in the Americas, Europe, and the Asia Pacific. Now, the company's CRM platform includes marketing, sales, service, and content management systems, as well as integrated applications such as search engine optimization, blogging, website content management, messaging, chatbots, social media, marketing automation, email predictive, lead scoring, sales productivity, knowledge base, commerce, conversation routing, video hosting, ticketing, and help desk tools, and customer NPS surveys, analytics, and reporting. That was a lot. It also offers professional services to educate and train customers on how to leverage its CRM platform, as well as a phone and email and chat-based support services. Now, the company serves mid-market businesses to business companies. HubSpot was incorporated in 2005 and is headquarters in Cambridge, Massachusetts. Now let's see some of the biggest news that came out in the past couple of weeks of this company. So they did report their Q2 earnings a couple of weeks ago, and they beat estimated earnings by 2.33%, reporting an earnings per share of 44 cents versus an estimated 43 cents. This exceeded my expectations, with overall growth still exceeding 30%. That's definitely good. So let's go ahead and look at some of the fundamentals of this company. Well, the stock is currently trading at $351.58 a share, with a market capitalization of around $16.9 billion. Now, the company is projected to have about $1.69 billion revenue for 2022, with negative earnings of around $132 million. Now, the company's the revenues are projected to significantly increase over the next few years to around $2.61 billion by the end of 2024, but still have negative $53 million of earnings. Now, the company does have high growth revenue. It is forecasted to grow over 22.45% per year. Now, looking at some of the key measures of this company, it's for some of the valuation analysis and a few other analysis. The most appropriate valuation measure for this company is the price to sales ratio. The price to book ratio is excluded since it most likely underestimates the company's book value by overlooking the hidden assets such as intellectual property. Now, while the PE and the PEG ratios are not as meaningful since they don't have negative earnings, therefore the company seems highly valued with a price to sales ratio of around 12.8%. Or 12.8 times, I'm sorry, one of the highest in the software industry. But the company is a good value based on its price to sales ratio compared to the peer average, and the peer average is 15.7 times. Now, what is the fair price of the company when looking at its future cash flows? Well, for this estimate, we use the discounted cash flow model, and HUBS is trading well below the estimate of fair value, which I put at around $380 a share. Now, let's look at the profitability of the company. Now, although they're losing money on an operating basis, the company is one of the more profitable companies in the software industry. Now, its gross margin of 80% is among the strongest of any peer, while the operating and net margins right now are above the industry medians. Now, they currently are unprofitable, and they're not forecasted to become profitable over the next 3 years. And like many of its peers, the company does not pay any dividends. Now, let's look at the growth of this company. So HUBS saw earnings decline in spite of positive revenue growth during the past 12 months. Now, additionally, the average company in the software industry was able to improve its earnings result over the same period. Now, with the earnings trend, losses have increased over the past 5 years at a rate around 13.9% per year. It's going to stay about that level and then slowly increase in 2024 projected. Now, looking at the financial strength of the company, they have a debt to total capital ratio of 34%, which is in line with the software industry medium's norms. Now, they have been reducing debt. The debt to equity ratio has been reduced from 141.7% 5 years ago to that 34% today. Now, the short-term assets of $1.5 billion exceed both its short-term liabilities of $662 million and its long-term liabilities of $740 million. They have more cash than total debt, basically. And they do have a stable cash runway. Now, while they're unprofitable, it has enough sufficient cash runway for more than 3 years if it maintains its current positive free cash flow level. The free cash flow is growing about 45% per year. Now, we have to note that shareholders have been diluted in the past year, with total shares outstanding growing about 2.2%. So what do the analysts say specifically regarding this company? Well, the current consensus is a buy recommendation, with 51% of people saying buy and 37% saying strong buy. Now, the average price target over the next 12 months is around $437 a share, with a high estimate of $613 and a low estimate of $325. And going over a few of the analyst reports that I found, the Street Quant Ratings has a sell recommendation on this company. This is driven by several weaknesses, which they believe should have a greater impact than any of the strengths, and could make it more difficult for investors to achieve positive results compared to most of the stocks they cover. Among the areas they feel that are negative has been generally disappointing historical performance in the stock itself. Now, the Forward Equity Research Report has a hold recommendation on HubSpot. Now, as a result of their systematic analysis of the 3 basic characteristics that they look at earnings strength, relative valuation, and recent stock price movement. Now, the company has suffered from a very negative trend in earnings per share over the past 5 quarters. However, while recent estimates for the company have been lowered by analysts, it's posted better than expected results. Now, based on operating earnings yield, the company is overvalued compared to all of the other companies that they cover specifically. And they say that share price changes over the past year indicates that the company will perform very poorly over the near term. Okay, so let me bring it back over here. So what are my thoughts? Am I a buy, hold, or sell recommendation on HubSpot? Here are my thoughts. Now, the recent second quarter results exceeded my expectations, with overall growth still exceeding 30% despite meaningful foreign exchange headwinds that it's currently facing right now. Revenue growth remains impressive, while other positive indicators can be found in the billings growth, new customer adds, and retention. Now, however, macro pressures causing lengthening deal cycles, along with worsening currency impacts, drove HubSpot to lower its full year outlook. Now, I believe HubSpot is a leader in customer service and engagement software for the mid-market and has a long runway for growth as it gathers new clients, moves existing clients up the tiering pricing structure, and sells multiple hubs to larger clients. Now, I see small and medium businesses and the mid-market as being underserved right now by enterprise software providers, as the smaller deal sizes make it harder to serve efficiently. Therefore, I believe that HubSpot's robust and expanding suite has helped carve out a meaningful niche in the marketplace. Now, while the company represents a higher return on investment offering that should also benefit from consolidating IT vendor, now I see long-term growth in the front office software, and I don't believe that this is fully reflected in its current stock price at the moment. Now, I view the company as well positioned in marketing automation software with an expanding portfolio and a robust growth profile coupled with solid execution. So based on all that information, I am a buy recommendation on HubSpot with a 12-month price target of about $440 a share. I would sum it up by saying flawless balance sheet and good value. Now, HubSpot doesn't have to beat out the Salesforce or Microsoft, by the way, but by offering a credible solution to the mid-market, I think it can grow rapidly to an underserved niche. Now, the record of introducing new solutions in adjacent areas, upselling existing customers and moving customers up to the stack as they grow has driven strong revenue growth thus far and seems highly likely to continue over the next several years. So let's talk about the risk to my recommendation. Now, even though the company is expected to produce revenue growth toward the high end of peers and the premiums may be justified, higher absolute valuation levels offer less room for missteps and therefore carry greater inherent risk, in my opinion. At higher valuation levels, companies can often become momentum stocks, where they are punished severely if they do not deliver against expectations that they are regularly higher than consensus figures indicate. Now, another risk factor is churn. Now, HubSpot does business with companies of all sizes, but typically caters to the mid-market segment. Now, I believe smaller customers typically have higher churn rates. Now, I think this could be exacerbated in the company's case, as most sales are monthly rather than annually. Management does not disclose the churn statistics beyond the net dollar retention rate. And another factor to consider is the competition. Now, HubSpot faces stronger competition from Salesforce, Microsoft, Oracle, SAP, and other large and small. I believe that the legacy providers are most at risk for market share loss, but I also believe that these larger software companies are usually doing considerably larger deals than HubSpot. But what do you think? Please leave your comments down below. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell for your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.